Inflation, debt, MMT, and Bitcoin all rolled into one. Just add Tesla and you'll have clickbait extraordinaire for this video. But we're going to read this by the boys over at First Trust Financial, Brian Westbury, Dateline December 28, 2020. This year has been exceptionally interesting for 2020 for investors. Stocks have soared to new heights. Mortgage rates have fallen to new lows. Bitcoin, which was languishing at about 5,000 in mid-March, is now above 27,000. Bitcoin backers viewed as protection against fiscal ineptitude and policy mistakes, which could lead to the devaluation of sovereign currencies. Phone's ringing. In other words, inflation. And if you followed government policies this year, you understand where they are coming from. But it's not just cryptocurrency investors that fret about inflation. Gold bottomed at 1471 in March and now is at 1900. Copper, silver, lumber, wheat, and soybeans have all soared this year to more than 5-year highs. So I thought it'd be fun to look at JP Bullion. This is where I buy my gold. I haven't bought any for a while. Gold right now is at 1949 is the ask. And then if we go to the trend, it's I don't know why they got 31 years, but for 31 years, it's up $1,527. All right, so if we take the current price at 1949, subtract the gains that we had over the last 31 years, we start with $422 at the beginning period of this time, 31 years ago, just looking at puppies. So I thought it'd be fun if we go to this right here, which is our portfolio visualizer, and I say, okay, what if we started the S&P 500 at 422, which is what the price of gold was 31 years ago? Where would the S&P 500 be right now? And what do you think? So you can see I got small cap index. We got gold and precious metal mutual fund from USA off, Pablo. Hold on a second. Good boy, Pablo. Trying to train old Pablo there. Good boy. And then we got the S&P 500. Again, we're starting at 422. All right. And gold right now is at roughly 1950, so it's up about $1,500 over 31 years. Look at this. Here's the USA gold and precious metals at $2,200, which is roughly right in line with the price of gold. A little bit more, but you can see that's. Here's the S&P 500, 10,947. Small cap index, 10,560. So you've made 8,000, about 8,500 more in just good old-fashioned index funds than you did in gold bullion or even a gold-backed mutual fund. Yeesh. Now let's keep going. I think that speaks for itself, does it not? We can even look back to, I don't know what he's got. JM Bullion has 5 years. It's gone up 77%. So from 846 is what the starting point was. So we got 1949 now minus 846, 1103 5 years ago. And we can say 1103, and we'll go back, 5 years ago. That'd be 2020, 19, 18, 17, 16, 2016, and see where we are here. I would have no idea. Let's take a gander, shall we? S&P 500. What's this? Is that the? Yeah, right there. That's the gold and precious metals. So no, that's small cap indexes in the blue. That's up to 2,074. Red is gold, which is 2792, and then the orange is S&P 500. So over 5 years, gold has spanked us for sure over 5 years. So there you go. But 5 years is not what we're trying to invest for, right? Because we're trying to invest for cash flow in the future. All right, Bitcoin, we already talked about that. A Federal Reserve calculation of future inflation expectations expects inflation to be 2% annualized in the 5-year period starting 5 years from now, so roughly 2026 to 2030, which is an increase from the 1.8% expected a year ago and much higher than the 0.8% projected back in mid-March. So basically, the Fed doesn't know what the hell they're talking about. It's all understandable. The monetary base has expanded by 1.6 trillion since February, and M2 has grown by 25% in the last year. But the Fed doesn't plan on lifting interest rates till at least 2024, and I highly suspect they won't then either. What's going to be the cause to make them raise interest rates? I mean, just remember, my friends, if they do raise interest rates back to a historic level, the number two, if not the number one line item on the federal government spending would be the service the debt, more even so than military budget, and I think just right behind actually the entitlements, Medicare and Social Security. So why it's not going to happen? I'm just not going to happen. Every penny of government spending is taxed or borrowed from the private sector, and these transfers of wealth and income from current and future taxpayers distort the economy. Some think that MMT, modern monetary theory, allows the Fed to print money to finance this debt with no consequence. Let's see. But for the time being, this is manageable. The past fiscal year, net interest on the U.S. federal debt was 1.6% of GDP versus 1.7% in 2019 and 3% in 1980s and 1990s. Yeah, you got that right. In spite of soaring national debt, as well as a plunge in the GDP, the interest burden was a smaller share of GDP than it was the year before, and roughly half of that from 30 years ago. As a result, although the yawning budget is not good and not sustainable in the long term, the U.S. is not Argentina. Just because a doctor tells you the problem is with your thyroid isn't fatal doesn't mean you wouldn't be better off without it. I hear this is not sustainable in the long term. I'm not saying it is. I just say why. We've been talking about debt crisis going back until you just watch old Louis Rukeyser videos from the late 80s and Wall Street Week. And you can even read opinion pieces and whatnot, even back in the early 1920s, talk about the debt. We've been hearing this forever. Now, look, I'm not saying we should just go ahead and beat MMT. We're already in it, though. Let's not pretend. I mean, thankfully, had a conservative president and a conservative government from at least, in terms of the House and Senate in the first 2 years of Trump to restrain fiscal spending. Oh yeah, we didn't restrain fiscal spending. The issue is this is it. As long as the GDP continues to grow, this is what Dick Cheney and Newt Gingrich says. We can basically grow our way out of debt. Deficits don't matter is what they're saying as long as GDP kicks in. They could be wrong, but the facts are we don't see that right now. For the record, even though we are upbeat on the economy and U.S. equities for 2021, we don't support any part of MMT. The narrative of COVID and shutdowns, the denial of fiscal reality, and the power of politicians and media mean for the time being this is our path, MMT. However, eventually math wins. New York, Illinois, California, and other states are watching people vote with their feet. We will see how they respond. It may surprise all of us. After all, politics is often backwards. Nixon went to China. Clinton reformed welfare. With massive current deficits and future growing deficits due to entitlement programs, the stars may be starting to align for some historic and long-awaited reforms. Yeah, we'll see. I'm not holding my breath, but I don't know, man. They always say this is going to come back to bite us. I mean, okay, I'm not disagreeing with that, but when, where, how? I find at some point you say, well, it hasn't happened. It doesn't mean it can't happen. It just means it hasn't, and we've been hearing the same story time and time again. As long as the problem that we have, frankly, is the shutdowns. That hurts the economy. That hurts growth. That hurts the entrepreneurship is what makes America great. You get rid of entrepreneurship, small businesses, and you rely on a couple of big corporations, the federal government, that is what hurts output. And that is what hurts innovation, which is what enhances productivity, which gets your GDP to grow. That is what could be the straw that broke the camel's back. But we shall see in the upcoming year where we stand with that. If there's going to be more lockdowns and oppression, or they're going to get their freaking foot off the neck of entrepreneurs and let them just explode with creativity. We shall see. All right, love to hear your thoughts.